Hello friends, so I welcome you once again in my class. So today we are going to cover credit risk, market risk, operation risk, liquidity risk. So these are the part of your module B, and in this we'll be covering the chapter that is called 11th, 12th, 13th, 14th and 15th. So starting with, we have to see starting with the credit risk. So what is credit risk mitigation? So mitigation is nothing but reduction. That means risk reduction. So it is a process through which credit risk is reduced or transferred to counterparty. That means risk is there, but it is a process by which we transfer the risk to the other party. Okay, and CRM techniques are adopted at transaction level as well as portfolio level. That means credit risk mitigation is used at two levels. Number one level is at transaction level, another is the portfolio level. So transaction level means number one case is that obtaining cash collateral and obtaining guarantee. So cash collateral means for need we carry out transaction, we take something in cash, means like FD may be there, RD may be there, or any something that can be easily converted to cash. And second, we can obtain a guarantee also from third party guarantee. You might have seen giving advances to some person, we take the guarantee from the third person also. Okay, and at portfolio level we do for the process like securitization is there, collateral loan obligation, that is also called COL. Collateral loan obligation is also called COL short form, and collateral note is also called CLN. Okay, and credit derivative. So we'll discuss one by one, just because portfolio level means whatever we are handling some asset uh, for future is uh, future use, and that will be generating the income also for the bank. Okay, so we'll see one by one. So securitization is a process transactions in which financial securities are issued. Okay, this point is very important. Financial securities are issued against cash flow generated from pool of assets. That means bank may be holding some pool of assets, many assets may be there, like house may be there, land may be there as a mortgage. So what bank do? That means they issue the financial securities against the cash inflow. So that means whatever cash is generated against that, they issue the securities. So this is called securitization. But what happened? What if you issue the securities? You have to pay the interest. So how the interest is paid? So cash flow arising from the receipt of interest and principal of loans are used to pay the interest or repayment of securities. You can invite the special purpose vehicle also. So special purpose vehicle, that means you can produce one lot. You can say, okay, this is my securities there. So people will come and they purchase the securities. Okay. So special purpose vehicle is created for the said purpose, and originating bank transfer asset to the SPV. Okay. So whatever asset is included, that will be transferred to the SPV, and it is to the financial security. Okay. Then moving ahead, collateral loan obligation. I told you CLO and CLN, both are same, but little difference is there. So it is also form of securitization only, but bank removes assets from balance sheet and issue tradable securities. Okay, that means in collateral loan obligation, whatever is done, uh, from the it is removed from balance sheet and they create one asset. Okay, I am again I am issuing the security. That means let the cost may be 10 rupees, like a share. Okay, so it is a tradable security, and they become free from regulatory capital. That means now they will not be part of the balance sheet, so now they can be traded like a securities. So these are CLO. Now CLN, we see the CLN. What is the meaning of CLN? Means credit linked notes. So the basic difference between CLN and CLO is that CLO is many people they can purchase the securities, whereas CLN only one person. Okay, so CLO defines one security. Note in the following manner. So what is the manner? CLO provides credit exposure to diverse pool of credit, whereas CLN relate to single credit. Okay. CLO result in transfer of ownership, whereas CLN ownership do not provide such transfer, because CLO many customers they will purchase the security, so there is also transfer of ownership, where CLN the ownership is not transferred. Okay, but single credit will be given. CLO may enjoy higher credit rating than the that of originating bank. Okay, so CLO will have higher credit than the that of the originating bank. Now next, moving ahead, next is the credit derivative. So it is managing risk without affecting portfolio size, and risk is transferred without transferring of asset from balance sheet through OTC bilateral contract. Okay, that means one derivative. And a derivative word we have already heard, and we have already studied also, because derivative many commodities, or you can say many credit, but in this case many credit will be pooled up and derivative will be created. So these are off balance sheet financial instrument. So financial instrument only. Credit insurance and LC are similar to credit derivatives. Okay. Credit insurance and LC are the similar to credit derivative. Under the credit derivative, prospective buyer enter into an agreement with the prospective seller for transfer of risk at the notional value by making a premium payment. That means buyer will come into contact with the seller, and they will make one agreement, and he will pay the premium, and he will say, I am taking the risk. Okay, so now naturally the risk will be transferred to the buyer only. Okay, so in case of delinquencies, default, foreclosure, prepayment, the prospective seller compensates prospective buyer for the losses. Because prospective buyer may incur the loss if he is purchasing the security. So settlement can be physical or cash. Under physical settlement, asset is transferred, where cash settlement only loss is compensated. Okay. So if buyer wants to actually take the position of the what is the asset is there, so he can take. But if you want to settle the cash, that means whatever the loss is there, because over the time what happened, no, the rate or cost might have gone down, so he will just pay that cost, and he will settle the derivative. Okay. So credit derivatives are generally OTC instruments, that is over the counter, and ISDA, that means International Swaps and Derivative Association, has come out with the documentation evidencing such transactions. Okay, that means they have some sort of documents, and what are the transactions that can be carried out. Okay, there's, like you can see here, credit default swap, total return swaps, credit linked notes, credit spread options. So these are the credit derivatives, means names are given here. Credit default, I just repeat here, credit default swaps, total return swaps, credit linked notes, and credit spread options. Okay. Sometimes it's feel difficult for you to remember, so don't worry. Just have some idea. Credit derivatives are, I'll just repeat once again here, credit default swaps, credit return swaps, credit link notes, and credit spread option. Okay. Now moving ahead. What is operational risk? So operational risk, we have already seen many times. Operational risk is the risk of loss resulting from inadequate or failed internal processes, people or system. Okay, because in the bank you might have seen either people are there or our computer system is there. Not only computer system, whole entire setup is called the system only. Okay. So Internal events such as dacoity, burglary, fire also called as the operation risk. Okay, sometimes people also commit mistakes. Sometimes system also get failure. So this is also part of the operational risk only. Okay, it also include legal risk. Also include legal risk, but exclude, this point is very important, strategic and reputation risk. Okay, this is very important. That means in operation risk we include the legal risk, but we do not include strategic and reputation risk. So this question can be asked out of this, where the strategic is the part of operation risk. So strategic and reputation are not the part of the credit risk. Keep in mind. Okay, sorry, operation risk. So strategic and reputation risk are not the part of operation risk. Then how will you identify? So operation risk can be identified actual loss database. From the database we can find out RBIA report. So this RBI report is prepared by your inspecting agency. They come for the inspection every quarterly, every half-yearly, every annually. From there also you can see risk control and self-assessment survey. Okay, key risk indicator, many indicators are also, like red flag is there, and some other indicators also. Every bank is following their own system. So from there also, and scenario analysis is very important. Okay, from the scene itself you can just where some loss is there. No, if some system has got failed, you must know, okay, your system is not working. So you can see the scenario also. Okay, next, 4 ways to manage. What are the ways you can manage the operation risk? Number one, the prevent. First is the prevent. Okay, so you have to be very careful, like it just don't happen. Like if frequent power failure in your area and your bank is located, so you have to be sure that your genset is working properly and it is serviced frequently, so that power failure is minimized. That means that risk can be avoided. So this is the one of the method I just think, prevent and reduce. Okay, if you are not able to prevent, you can reduce also, means minimize. You can minimize also, then transfer. Okay, so if risk is there, you can transfer to other party so that bank is not in loss, and carry and accept. Okay, and next is you have to accept that whatever loss had incurred. Now next, how to what are the approach you can minimize the operation risk. So what are the approach? This is very important. Approach are very important. They keep on asking. Okay, so number one, you have to remember, I repeat many times here, basic indicator approach. Basic indicator approach. Number two, standardized approach. So number one, basic indicator approach. Number two, standardized approach. And number third is AMA, advanced measurement approach. Okay, so I repeat again here. Basic, you can remember basic thing. You can remember the keyword. Basic is indicator approach, then standard. Basic, then standard. First is basic, then standard, then advanced. Okay, so all coming in the sequence. Basic indicator approach, standardized approach, and advanced measurement approach. So in basic indicator approach, 15% of average positive gross annual income. How we calculate, means how to this mitigated. So I'll just we see here. That means in basic indicator approach, 15% of this value is very important. 15% of average positive gross. Keep in mind, positive, not negative. Loss will not count. Okay. Average positive gross annual income of previous 3 years will be required of the capital. That means 15% of the last 3 years, you have to take only positive value. You have to will be requirement of the capital. Number one. To start with, the bank will have to adopt this approach, and huge capital is required to be maintained because 15% of the total profit. Okay. In our bank, estimated requirement of capital will be about 1000 crore. Means if you are calculating the 15% of that, that must be 1000 crore rupees. Okay. So this is the basic indicator approach. Very easy. Means what is the key word here? So 15% means what you have to remember here. I just insisting here. 15% of average positive. So what main is positive gross annual means only profit and 3 years. Okay, and in our India, that means in our country, estimated requirement of capital will be about 1,000 crore rupees. Okay, that is only for the operational risk. Huh? There are many risks also for them. Different approaches are there. So these are basic indicator approach. Now, the standardized approach, all banking activities are to be divided in 8 business line. Okay, so we'll see one by one. 8 business line. Number one is corporate finance, trading and sales, retail banking, commercial banking, asset management, retail brokerage, agency service, and payment settlement. So these are the all 8 activity. You also might have seen that this is all activity. Maybe in your bank may not be 2, 3, or 4 business, but overall putting together, these activities are carried out by the bank. Okay, corporate finance may not be in your bank. Okay, trading and sales is also there. Retail banking also very part of all bank. Commercial banking is part of all bank. Asset management not at the branch level, but is done by the circle office level or general office. Retail brokerage, it is done at local level. Agency service done at local level. And next, payment settlement is done by sometimes local or sometimes at the higher level. Okay. So within each business line, capital requirement will be calculated. So because these are 8 business lines here, though there will be capital requirement will be calculated as under. Okay, how you will calculate the capital? Now percentage is given here. By multiplying the average gross annual generated by a business over previous 3 years. In the previously also basic indicator approach, we took 3 years only. By factor, that is factor is given 12 to 18%. Okay, 12, 15, 12 to 18 means. So what are the activities which are to be multiplied by the factor? So you can see here, retail banking, retail brokers, and asset management, 12%. Okay, commercial banking and agency, that means this is the commercial, big size agency services. Okay, so 15%. And corporate, big size. Okay, big size means corporate trading and payment system 18%. So 12, 15, and 18. Okay, so you have to multiply by this factor to arrive at the capital requirement. Now next is the advanced measurement approach. This advanced is advanced only. So in this capital requirement is calculated by actual risk measurement. Keep in mind here, actual risk measurement system devised by bank's own internal operation risk measurement method. Okay, using quantitative and qualitative criteria. Okay, that means bank will be using their own system and they will be measuring where the risk is there. And our bank has started measuring actual losses and estimating future losses by introducing statement of overall risk loss data with effect from 2005. And for this purpose, minimum 5 years data is required for bank to switch over to AMA, Advanced Management Approach. So they have to see, they have to correlate, they have to prepare the statistics where the loss is there. For that purpose, they have to create the risk factor. That means how much risk is there. Okay, so how to calculate the RWA for operational risk? Means risk weighted asset. So RWA for operational risk. This formula is very important. We have used this once. Okay, in the numericals. Means RWA equal to nothing but capital charge divided by CAR. CAR, or you can say CRAR also. Okay, both are same. So RWA equal to capital charge divided by your 0.09. This formula is very important. RW we have found the previous numerical. So this, in this way, we can calculate what is the RWA in the operation risk. Now we see what is the scenario analysis of operation risk. So in scenario analysis, what happens actually? It is term used in measurement of operational risk on the basis of scenario estimate. Okay, banks use scenario analysis based on expert opinion. Okay, that means bank take the expert opinion in conjunction with external data to evaluate its exposure to high severity event. Okay, that means bank has to create one scenario and they have to judge based on the expert opinion. है ना? Many expert are there. So we take legal advice. We take opinion of the your sometimes what happens, your qualified builders, है ना? Qualified engineers, like we take advice. And in addition, scenario analysis is used to assess impact of deviation. Okay, what is the deviation? From correlation assumption in the bank's operation risk measurement framework. Okay, so that we can evaluate what is the potential loss is going to happen and how to mitigate this operation risk. Okay, so next, how operation risk can be mitigated. So buy insurance cover. It's very tool available nowadays for everybody, and bank also go for the insurance, like we go for the insurance of your house, insurance of lives, insurance of your bike, insurance of your car, है ना? So same thing, because we want to reduce the risk factor, so we want to mitigate the risk. So for that purpose we just pay premium annually. So one of the best method is insurance cover, if available, can reduce your operation risk. Okay, only when AMA is adopted for estimating capital. So for advanced management, this insurance cover is very good tool. Okay, but recognition of insurance mitigation is limited to 20% of total operation risk capital charge calculated under AMA. That means advanced measurement approach. So I'll just take one practical example here. Advanced management approach, under this estimated level of operation risk is calculated on the basis of, yeah, three factors are here. It's very important. One numericals also will show you. Okay, estimated probability of occurrence. That means we find out what is the probability of occurrence of that event. Okay, number two, estimated potential financial effect. What is the financial effect? Number two, probability potential. Okay, number third, estimated impact of internal control. Estimated impact of internal control. Okay, so we'll see one by one. Estimated probability of occurrence. This is based on historical frequency of occurrence and likelihood of in future occurrence. So we'll see from the past data how this event is happening. So like say I take example of when your staff is committing mistake. So from past we'll take 1 month, working day 20 days, and he has committed only slight mistake like one time. Okay, so we can say, okay, in next month the probability is 1 by 20 only. That means this occurrence, that means this event will happen only 1 by 20. That means 1 out of 20. So this is called the probability. So from the history we can say, okay, future in 1 month this may happen only once. So similarly for the whole year, if you are taking, that we can say, okay, in whole year 12 mistakes are likely to be happen because we have taken for the 12 months. Next, probability. Now what is this probability? So but this probability is something different, that because we are taking MA. So this probability is mapped on the scale 1 to 5. 1 means negligible risk, and 2 means low risk, 3 means medium risk, and 4 means high risk, and 5 means very high risk. Okay, now for calculation, for following formula will be using a number of, you multiply all three values. Okay, I'll just show you what are the all three values once again. estimated probability, number one, estimated potential financial impact, and estimated impact of internal control. You will multiply all three. Okay, I'll just show you. Yeah, here. That means estimated probability of occurrence, estimated potential financial impact, and estimated impact of internal control. Power 0.5 means you take square root. Okay, means you take square root of everything, big square root. You multiply all these three, and after that you take square root, you will get the value. Okay, I'll take example also here. Probability of occurrence 2. Okay, probability of financial impact 4, very high. Impact of financial control 50%. So impact of financial control. So that means you have to subtract from 1, because impact is 50%. So 50% means 0.5. So impact is 0.5. So what is not impact? 1 minus. Not impact means 1 minus 0.5 means 100. Another 100. So you multiply 2, 4 and 1 minus 0.5 means 0.5 only. So multiply 2 4 the 8, 8 5 the 40, decimal is there 4. The square root of 4 is 2. So in this way we can calculate this estimate level of operation risk. Okay, then what is the level of operation risk? So operation of level is low, because we are getting 2 value. Okay, next is ALCO, because asset liability committee is very very important. Asset liability committee meets at frequent interval and takes decision in respect of product pricing, maturity profile, mix of incremental assets, profile, interest rate, funding policy, transfer pricing, and balance sheet management. So this is done at the head office level. So not to worry, only you have to see what is their responsibility. That asset liability committee, they meet at head office level. Okay, they keep on deciding on various factors how to control this. And that means product pricing, they keep on changing the pricing. You might have seen they are changing the services offered by bank. Sometimes they'll say, okay, for the ATM I will charge something 200 rupees, something they will say, oh, I charge 400 rupees. Okay, then interest rate, you must be seeing the interest rate keep on changing, fluctuating. Funding policy, balance sheet management, and transfer policy. So these are done by the asset liability committee. Okay, now how market risk will be measured? So measurement of market is based on sensitivity and downside potential. Sensitivity we have already discussed. That means if 1% change is there, what is the change in that? So this is called sensitivity. And a downside potential is nothing but this is your standard deviation. How much standard deviation is there, and it is negative side. That will be variation from standard deviation. How it is? It will take only the negative side. Okay. Then sensitivity measure change in market rate of interest. Change in market rate of interest has inverse relation with the value of the bond. This is the called as sensitivity. Okay, that means the value of bond increases if the interest rate is decreases, and vice versa. Bond value high, interest rate low. Bond value low, interest rate high. So they are inversely related. But you have, if you take 1% change, so that will cause sensitivity. That means every 1% change in rate of interest, what is the change in the bond value? That is called how much bond becomes sensitive. Okay. And downside potential, I told you this is nothing but standard deviation. So how much there is variation from the standard deviation in the negative side, so it's called downward potential. Okay. And there are two methods for assessment of market risk. So assessment, keep in mind, assessment of market risk. So we are assessing the market risk. Now we have basis, point value, and duration value, duration method. So these are the very important methods of market risk. I'll repeat once again here: basis point value, or short we say BPV. Okay, BPV, and duration method. So we'll see one by one. Basis point value. This is change in value of security due to one basis point change. Keep in mind, it's like a sensitivity. Okay, but here we are taking BP and a basic point value and a basic point change in market yield. Higher the BPV, higher will be the risk. Direct relation. Higher the BPP, higher the risk. Okay, I'll take example here. Just see. Face value of bond 100 rupees. Bond maturity 5 years. Coupon rate 6%. Market price 92. So what is yield? 8% because 100 to 92. Okay, so 100 to 92, your yield is 8%. Now, with the fall yield from 8 to 7.95. So what is change here? So when yield has fallen from 8 to 7.95, that means yield has fallen from 8 to 7.95. The market price will rise, because it is always inversely proportional to the change in rate of interest. So market price will rise to 92.10. Earlier it was 92. Now it has become 92. What is the difference? So difference is 10, 0.1010. But what is difference in yield? You can see difference in yield 8 to 7.95. So 0.5%. Okay. Now difference in market 0.10. Now, so calculate the BPP. BPV. So BPV nothing but difference in market price divided by difference in yield. Okay, I'll repeat once again here. It's very important. BPV nothing but difference in yield will divide by difference in yield to the market price. So here is a market price. I'll just do here. So make it very clear. Divide by 0.5. So we'll get how much? 0.05. Okay. Here yield is not 0.5%, it's 0.05%. Okay. Yield is 0.05. This is 0.05. Okay. You can see from here. Okay. So if you divide here, you get the 2 basis points. So you can remember the formula. What is the formula? BPV. So BPV is nothing but difference in market price divided by difference in yield. So you get the what it changes. Okay. So now second is duration approach. So in this duration is the time that a bond holder must wait till number of years, means number of years, to receive the present value of the bond, that is 5 years. Okay, I'll just take example of 5 years bond with face value of 100. Okay, so what is the meaning of this? Okay, meaning is that total cash flow, whatever total cash is there, that should be equal to its present value. Understood? That means total cash flow, that means what is the duration at which total cash flow will be equal to its present value. So in this I have taken one example that you can see here. Duration approach means duration is the time, means we have calculate time. So I have taken the value here, that means 5-year bond is there, face value is 100 rupees, it is 6% coupon rate, and total cash flow is 130 to be received in 5 years and to be discounted to present value. Okay, which will be equivalent to amount received in 3.7 years. So what is the time here? So duration approach means 3.7 years. So in this we use one Macaulay duration is there, है ना? Sigma PVT divided by sigma PV. So this is the formula for the Macaulay duration. One more duration formula is there, that is called modified duration. Okay, this is formula used in case of bond is there. Okay, so what is the formula of modified duration? It means duration divided by 1 plus yield. So duration divided by 1 plus yield. And by using modified duration also we can calculate the approximate percentage change in price equal to modified duration into change in yield. Okay, so whatever modified duration you are getting here, you put your value and just put the change in yield, then you get the approximate percentage change in price. We'll take one example here. You can see example A. Bond with remaining maturity 5 years is presently yielding 6%. Okay, its modified duration is 5 years. That means we are only calculated here. So what will be the what will be duration? Okay, so what is the formula of modified duration? Duration divided by 1.5 YTM. Okay, here comma is here. So what is duration? You can bring YTM into this side. So duration is nothing but modified duration into 1 plus YTM. So 5 years modified duration, you can multiply please 1.06 because it's 6%. Okay, so 1 plus YTM, 1 plus YTM is 0.06. So 1.06. So you multiply with the 5. 5 is given here, so multiply, you get 5.30. Now see what is downside potential. So downside potential only capture the losses ignoring profit. We have reiterated many times. It integrates sensitivity with volatility with observed effect of uncertainty. This is most reliable measure of risk. Now questions can how to calculate the downside potential. So downside potential is calculated by the method is called value at risk. It's called VAR. So it means how much can we expect to lose in future? What is the potential loss? Okay. So we can calculate by this. So if VR is equal to X, so if value of VR equal to X, it means we can lose up to maximum of X value over the next period. Say whatever duration we can, if we are getting for that duration, so we can say, okay, we are losing this much and in this duration. Okay. And for this purpose, confidence level of 99% is taken into account. Okay, I'll just take one example here. A bank having 1 day VR of 10 crore with 99 confidence level. Okay, it means that there is only one chance in 100. Okay, because 99 confidence level is there. So that daily loss will be more than 10 crore under the normal condition. Okay, now we are in days in a year based on 250 working days. Now if you want to calculate VR for the whole year where 250 working days are there, so because it is for 1 day it was 1%. Okay, now I'll repeat once again here. That means bank is having 1 day as a VR, and bank may lose rupees 10 crore with 99% confidence level. That means there is only one chance in 100 because confidence level is 99%. So there is 1 out of 100. That daily loss will be more than 10 crore under normal conditions. So we are in days in a year, means in a year working day 250. So 1 by 100 because chance is 1 by 100. So 1 by 100 into 250. So we get 2.5 days per year. So in this way we can calculate the VR also. So what we will be learning one more term here that's called back testing. So back testing the process where model based VR is compared with the actual performance. That means when we prepare VR, that means that VR we have to test with the actual performance. It tells us whether results fall within the pre-specified confidence band as predicted by the VR model. Okay, this is called back testing. One is also called stress testing. So it seeks to determine the possible change in market value of portfolio that could arise due to non-normal movement in one or more market parameters such as interest rate, liquidity, inflation, exchange rate, and stock price. And that means this is called stress testing. And for this purpose, here are the 4 tests that we can apply here. These are simple sensitivity tests. If risk factor is exchange rate, shock may be exchange rate like 2%, 4%, 6%, etc. etc. I'll repeat once again here. Simple sensitivity test. If risk factor is exchange rate, then shock may be exchange rate like 2%, 4%, 6%, etc. Okay, next is the scenario test. It is leading stress testing technique. The scenario analysis specifies the shock if possible event occur. It assesses the potential consequences for a firm of an extreme. It is based on the historical event or hypothetical event. Okay, that means we take the historical event, that means past data, and this technique is based on the scenario analysis. Okay, next is the maximum loss. The approach assesses the risk of portfolio by identifying most potential combination of move of the market. That means how much loss you can incur. Okay, how much loss, maximum loss. That is okay. And extreme value theory. The theory is based on the behavior of tail. That is the very high and very low potential value. Means suppose you are incurring the 10 crore loss, then how much loss, very high and very low, are probable distribution curve. So we make the probable distribution curve. You might have seen like this now. So in that we take the what is the extreme values are there. So this is called extreme value theorem. And how these risks can be controlled. So risk management and control market risk is controlled by implementing business policies. Okay, and setting the market risk limit or controlling through economic measure with the objective of attaining higher RAROC. So what is full form of RAROC? Risk adjusted return on capital. RAROC means risk adjusted return on capital. So risk is managed by following: number one, limit the trigger, risk monitoring, and next is models of analysis. Okay, so we can create the model also. So I'll repeat once again. 3 are here. Number one is limit and triggers. Risk monitoring, like we are using the limit. Okay, like we fix the limit. Okay, this is the limit you can expend the money. In also in banking system also, no, we give some power to the managers. Okay, the approval of the or sanctioning of loan is this is your limit. Okay, and trigger system, I can see the red flag accounts are there. So these are triggering. Okay, SMA 0, SMA 1, SMA 2, these are the technique of triggering. Okay, risk monitoring, and we can monitor the risk also, and model of analysis, we can prepare the model also. Then it's very important how to calculate capital charge of market. The Basel committee has 2 approaches for calculation of capital charge on market price. Okay, on market risk. So number 1 is standardized approach, and number 2 is internal risk management approach, IRMA. It is also called IRMA, internal risk management approach. So under standardized approach, there are 2 methods. Number is maturity method and duration method. RBI has decided to adopt standardization approach. Okay, you keep in mind, na? This question can be asked. Na? Standardization duration method to arrive capital charge on the charge on the market risk. Okay. So here's the one list that's given investment rating capital required. So AA to triple A means it is 0%. A plus to triple B residual terms of maturity. This list is given here. Less than 6 months 0.25, less than 24 months 1%, more than 24 months 1.6%, other investment 8%. Now we'll see how to calculate RWA, means risk weighted asset. Okay, if capital charge is given. So same formula we have repeated in operational risk also. RWA for market risk is equal to capital charge divided by 0.09. So if CAR is 9%, so CAR is also called CRAR. Other risk and capital requirement. Other risk like liquidity risk, interest risk, strategic risk, reputational risk, systemic risk are not taken care of while calculating capital adequacy in the bank. So we are taking only three risks: CMO, credit, market, and operation. Okay, because in the denominator we are taking the RWA of all these three only. Okay, now we'll see the pillar 2. Supervisory review process, RSRP, has two issues. Okay, to ensure that bank is having adequate capital in the form of CRAR, to encourage bank to use better technique to mitigate the risk. Now the focus is on the risk mitigation. So SRP concentrate on three main areas. Risk not only fully captured. Why they are focusing three main areas? Because risk was not fully captured under pillar 1. Okay, that is interest rate risk, credit concentration risk, liquidity risk, settlement risk, reputational risk, some many risk. So in pillar 1, this interest was not taking into account. That is the main concentration of supervisory review process. Okay, because pillar 1 only talk about the capital. Now, this pillar ensure that, which pillar? Supervisory review. So this pillar ensure that bank have adequate capital. This process also ensure that bank management develop internal risk capital assessment process and set capital target commensurate with bank's risk profile. That means they have to have capital, more the risk, or more risk, more capital. Okay. Central bank means RBI ensure through supervisory measure that each bank maintains required CRAR. In India, 9.0% is there, that means 9%. And component of tier 1 and tier 2 are in accordance with the Basel 2 norms. Okay. RBIA and other internal inspection processes are important tools for the bank supervisory technique. Okay, so frequent inspections are very, very important. Every bank will prepare its ICAP. Okay, ICAP is called Internal Credit Adequacy Assessment Plan. ICAP is Internal Credit Adequacy Assessment Plan on solo basis, which will comprise the function of measuring and identifying risk, maintaining appropriate level of capital, and developing suitable risk mitigation technique. That means ICAP. Now, what RBI has directed is not responsibility of RBI or Basel. They are the guiding factor. So, bank their own self, they have to prepare their own internal credit adequacy assessment plan. They have to assess themselves so that appropriate level of capital is maintained and risk is mitigated. Okay, moving ahead, we'll see the market discipline, third pillar. So market discipline is the complete disclosure and transparency in balance sheet. That means every bank has to be very, very transparent in market disclosure. They will disclose everything to the public. What they will disclose? They will disclose financial statement of the bank, and these are the requirements. Capital structure, component of the tier 1, tier 2 capital, bank's approach to assess capital adequacy, and assessment of capital risk, market risk, and operational risk, And bank aspect like asset classification, net NPA ratio, moment of NPA, provisioning, frequency of disclosure. Okay. So larger bank with capital rupees 500 crore or more will disclose tier 1 capital, total capital, CRAR or CAR on quarterly basis on the website. That means all banks nowadays, every bank, big banks, they are preparing balance sheet in the financial year, and they disclose in the website. They publish in the newspaper, and but in addition to that, quarterly basis also they have to disclose their tier 1 capital, tier 2 capital, and CAR. Okay, so now there is also risk weight on NPAs, because nowadays NPA, all banks are focusing on NPA, because NPA should not increase. NPA means non-performing assets. So risk weight on NPA of specific provision will be calculated as under. Okay, so risk weight on NPA net of specific provision will be calculated as follows. So when provision is less than 20%, that means nowadays banks are making provisions on NPA, so they have to calculate the risk weight. So what is the risk weight? If provision is less than 20%, and means risk weight will be 150%. When provision is at least 20%, means more than 20, so 100%. At least 50, so 50%. Okay, and next provision, we'll see the secured, unsecured, standard secured rate 15%, provisioning, so 150. Substandard unsecured, so I'll repeat previous one also. Substandard secured 15% is provisioning, risk weight is 150%. Substandard unsecured rate provisioning is 25, so 100%. Doubtful D1 secured 25%, provisioning 100. Doubtful D1 unsecured 100, 50. So D2 secured, provisioning 40, 100. And after this one will further list it there. So you cannot remember the risk weight. You can, but provisioning rate you have to remember, because numericals are asked based on the provisioning. Okay, so they can ask the what is the provisioning you will do on that. So rest, doubtful D2, D3, you have to make 50, 50, 50%. Okay, so this was the risk weight associated with the your standard and substandard, because substandard also part of the NPA only. So moving ahead, off balance sheet items. So off balance sheet items have been bifurcated as follows, in two parts, means non-market and market. Okay, so off balance sheet are two types. So there is two-step process for the purpose of calculating risk weighted asset in respect of off balance sheet items. Number one, notional amount of transaction is converted into credit equivalent factor. This one new term is coming here. So notional amount of transaction is converted into credit equivalent factor. This is called by multiplying the amount by specified credit conversion factor, CCF. So it is converted into credit equivalent factor by multiplying CCF. So credit conversion factor. So there is one value is there. So you have to multiply with the credit conversion factor. So you get the credit equivalent factor. The resulting credit equivalent amount is then multiplied by risk weight. Okay, applicable to counterparty, because whatever the counterparty is there, that means what their risk weight having, that we have to multiply with the CEF, means whatever you get CEF now, credit equivalent factor, in that multiply the risk weight. Okay, and or means you have to multiply with the risk weight of the counterparty or to the purpose for which bank has extended the finance or type of asset whatever is higher. So three factors are here, means you have to see the three factors. Means number one is the type of asset, risk weight of type of asset, or risk weight of counterparty, or purpose. Okay, so whichever is having higher, you will take the risk weight of that. Okay, next, where the off balance sheet item is secured by eligible collateral or guarantee, the credit risk mitigation guidelines will be applied. Okay, so now next, non-market related off balance sheet items like direct credit substitute, trade, performance related contingent items, and commitment with certain drawdown are classified under non-market related off balance sheet items. Okay, that means these items are called non-balance sheet items. Number one, I'll just say direct credit, trade and performance, contingent item, and commitment, because they are not marketable. Okay, so how they are calculated? The credit equivalent amount is determined by multiplying the contracted amount of particular transaction by the relevant CCF. So they also multiply with the CCF. Okay. Non-market related off-balance sheet items also include undrawn or partially undrawn fund-based and non-fund-based facility, which are not unconditionally cancelable. That means you cannot cancel. The amount of undrawn uh, commitment is to be included in the calculation of off-balance sheet items. Okay, and non-market related exposure is the maximum unused portion of the commitment that could be drawn during the remaining period of the maturity. In case of term loan with respect to large project to be drawn in stages, undrawn portion shall be calculated with respect to running stage only. So we'll see the example here to understand. Okay, RBI guidelines is given the CCF they have given a list. Direct credit substitute CCF, general guarantee including standby acceptance 100% CCF is there. Okay, transaction rate contingent item performance 50%, warranty indemnity standby LC related to particular transactions short term doc LC for a swingware as well compromise 20% for both. Okay, 20% is there. Okay, now capital charge on unavailed limit credit charge on undrawn limit is calculated as under, means 20% on undrawn CC limit. Keep in mind 20% undrawn CC limit, 20% undrawn tier limit, term loan limit, which is to be drawn in a year, 50% undrawn limit, which is to be drawn beyond a year. Means if it is more than 1 year, then 50%. If it is less than a year, then 20%. Okay, you can see here. So 20%, I'll repeat once again here, 20% undrawn CC limit, 20% if time is less than 1 year, and 50% time is more than 1 year. Okay, I'll take an example here, it will be clear. In case of cash credit facility of ₹100 lakh, which is not, so this is a condition they have given here, not cancelable, where the availed portion of ₹50 lakh. So out of 100, 50 lakh. The availed portion is 60 lakh. Availed portion is 60 lakh. Unavailed portion of 40 lakh. So out of 100, they have availed 60 and unavailed is 40 lakh. It's clear? Will attract a credit conversion factor of 20. And you can see here now 20. Okay. So it is the cash credit facility, so CC limit. So it is 20%. Undrawn facility is 20% because it is a 1 year only. So time limit is 1 year also. So 20% it will avail the CCF factor. So credit equivalent of 8 lakh means if you find out 40 lakh, 20% of 40 lakh, you'll get 8 lakh will be assign to the appropriate risk weight as applicable to the counterparty. है ना? So that means now we'll take risk weight of the counterparty, arriving at the risk weight asset for the unavailed portion. The availed portion 60 lakh will attract risk weight as applicable to the counterparty. है ना? Whatever the portion has been availed, then we'll directly multiply with the risk weight of the counterparty. So in compliance of the new guidelines, banks have advised all the branches that the insertion of cancellation limit clause in the loan document. In case something cancelled, then they should insert the limit also. Insertion of limit cancellation clause in the loan document and levying of commitment charges. Okay. And moving ahead, we have arrived at the Basel 3. So Basel 3 on liquidity risk. So it was planned to implement Basel 3 in year 1/1/2013. 1st January 2013, it has been planned to implement. Okay. So purpose of reform is here, minimum common equity cap should be 4.5%. Tier 1 should be 6%. And conservative buffer must be 2.5%. So it will make you total 8%. Oh, not 8, 6, 7%. So it will make you 7% here, not 8. Because 4.5 plus 2.5 will give you 7% only. So 7.5% common equity, including conservative buffer. This is very important. Remember this. Okay, as per Basel 3, I'm talking about, not India. Okay. Now, tier 1, 6% plus 2.5. If you make it total 8.5%. And total capital 8%, 2.5 and 10.5%. So as per Basel, this value is very important. You must remember this. Okay. Then transition arrangement as on 1/1/13, because it was implemented, the bank will meet new minimum requirement in relation to risk weighted assets as under. I just 3.5 common equity plus 4.5 equal to 8.5%, 8% of total capital and risk weighted asset. Now we'll do one more numerical of VR, how VR is calculated. So market, once again, what is the formula? Market factor sensitivity, daily volatility and probability, and take the square root. Suppose impact of 1% change in interest is 6,000. Daily volatility is 3%. Confidence level is 99%. So probability of occurrence of this level is 2.326. Okay, probability. That means this probability is related to given the 2.326. Now multiply. So one day means now multiply 6,000 into 3 daily volatility and probability factor. So market factor 6,000. Suppose impact of 1% change in interest. So this is a sensitivity 6,000. Daily volatility 3 and probability is 2.3. You multiply, you get 41,874. So in this way we can calculate VAR. Okay. So Macaulay formula we have already done, and modified duration we have already done. Okay. Now we'll see the one question or credit risk, how to find risk weight asset. Okay, one example is given here, so it's very helpful for you. So you can just we'll do the numerical, then we'll finish our class. Okay, fixed asset is given 500 crore, government securities 5,000 crore, standard asset retail 3,000 crore, HL housing loan 2,000 crore, other loan 10,000 crore. Okay, substandard assets secured 500 crore, unsecured 150 crore, and doubtful 800 crore. Now see the solution. Retail. Now, because retail the 75%, so home retail 3,000 to 75, you get that value must be given, and housing loan 50%, other loan 100%, government securities nil, so 0. Okay, and substandard, you can say here secured 150, 500 to 150, 750, and substandard unsecured 100% of 150, so 150 crore. Doubtful 800 to 100%. So this now total this to total risk weight asset is coming 4,009. So direct we can multiply with the risk weight asset, whatever percentage given, you can multiply with that, and you can get the total of that. So with this, we'll finish our class, and we have finished our module B. And I will reiterate once again here, because we are revising here, so I might have left something that you wanted to learn. So please, you can refer your book. And my advice is that this BFM paper is little bit difficult as compared to the first one, ABM. So you can solve more numericals from your book. And with this, we'll finish our class. So good day, enjoy. Very soon we'll start our module C, treasury management, and after that module D, that is called your balance sheet management. Okay, bye, good day.